Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business reports. Today we are diving into XFLH Capital Corporation SS-1 filing. And let me tell you, this one is a wild ride. It is about their plan to go public, and it is full of all sorts of insider dealings and big promises. So, what is the big story here? XFLH Capital Corporation is a blank check company, basically a shell company formed to help another company go public. They were looking to raise about $60 million to go out and find a business to merge with, likely one based in Asia, and specifically China. But nestled within this plan are some serious red flags and fascinating arrangements that tell a deeper story about how these deals really work. Let S scroll into the details. Right off the bat, they're retelling us this is their big debut, their initial public offering. They plan to sell 6 million units at $10 each. Each unit comes with one ordinary share and something called a right. Now, this right is a bit like a coupon, letting you get a small fraction, specifically 1/7, of another ordinary share later, but only if they actually pull off a business combination. So, you are not just buying a share, you are buying a small piece of a future possibility too. They also giving the underwriters an option to buy even more units if things go really well. Now, who is behind all this? Their sponsor, XFLH Holdings Limited from the British Virgin Islands, is buying a chunk of these units, about 125,000 of them, also for $10 each. This is called a private placement. It happens at the same time as this public offering. This is important because it shows who is invested heavily from the start. This sponsor is putting in a significant amount of money, over $1.2 million for these private units, and also for what they call founder shares, which they bought for a tiny amount, just $25,000. That is a huge difference, and I'll talk about what that means later. And speaking of compensation, there is a whole table dedicated to what the sponsor and its buddies might get. They're re-getting founder shares, those private placement units, a monthly fee of $10,000 for office space and services, repayment of loans they might make for expenses, and working capital loans that could even be swapped for more units. Plus, any out-of-pocket expenses for finding a business to buy are reimbursed. It seems like there are many ways for the sponsor to get paid. This is a big deal, folks, dilution, because the sponsor got their founder shares for practically pennies when you, the public investor, buy in at $10 a share. Your stake is immediately worth less in terms of what the sponsor paid. It means that initial ownership structure already sets up a situation where the sponsor has a massive head start, and you, the new investor, could see the value of your investment diluted right from the get. And here is where the numbers start to get really telling. This table shows the dilution. Look at this. Even with a full exercise of the over allotment option, the net tangible book value per S-share is about $7.69, while the offering price is $10. If you do the math, that is a pretty significant chunk of money disappearing as dilution right away. It is the price you pay for investing in a SPAC structure where insiders get in at a fraction of the cost. Now, let's talk about who is running the show. A big red flag here, most of the top brass, the CEO, CFO, and director nominees, have strong ties to China. Many are Chinese citizens living in China or Hong Kong. This isn't necessarily bad, but it does raise questions about how easily investors in the EU can interact with them legally and what kind of business environment they're most comfortable with. It also means that if they decide to pursue a business combination with a Chinese company, there could be a whole new set of risks and regulations to navigate. This is critical. If XFLH Capital decides to merge with a Chinese company, the Chinese government can step in and influence things. This includes approvals for the deal, rules around offshore offerings, and even data security. It is a reminder that investing in companies with deep ties to China comes with unique political and regulatory risks that are beyond normal business challenges. And here is the auditor's report. They are issuing a strong warning, substantial doubt about the company's ability to continue as a going concern. This means the auditors are saying, hey, this company might not be able to stay in business for much longer without new funding and a successful business combination. It's a harsh reality check for any investor. Scroll report of independent registered public accounting firm material, uncertainty related to going concern scroll. They repeat it again in the notes to the financial statements. The company has no cash, a working capital deficit, and a history of losses. They are relying heavily on this public offering and potentially loans from the sponsor to stay afloat. It is clear they are in a precarious financial position right now. Here is another interesting tidbit. Unless they merge with a company tied to their own sponsor, or their board can't figure out the business's value themselves, they're not obligated to get an independent opinion to say the deal is fair. This means shareholders are pretty much trusting the board's judgment without an outside expert's validation, which can be a bit of a gamble. So how are they going to pay for this business combination? They talking about using cash from this offering and the private placement, your money and the sponsor S-money. But they also open to using their shares, taking on debt or a mix of everything. This flexibility is common in SPACs, but it means the final deal could look very different from what you might expect. Now, for my take on all of this, XFLH Capital Corporation is playing a high-stakes game. They're looking to tap into the public markets to find a business, possibly in China, that needs capital. The immediate dilution for public shareholders due to the sponsor's cheap founder shares is a major concern. It highlights the inherent conflict of interest where the sponsor is incentivized to get any deal done, even a risky one, to protect their initial massive profit potential. The Auditor S statement about going concern is a serious warning. It tells us this company is on shaky ground without successful execution of their IPO and subsequent business combination. And let's not forget the China angle. While it opens doors to certain markets, it also brings a whole host of regulatory and political risks that can be unpredictable and impact the value of your investment significantly. Ultimately, investing in XFLH Capital Corporation, like any SPAC is a bet on the management team, ability to find a winning business and negotiate a good deal under tight deadlines and with considerable risks. The financial tables show how much dilution is baked into the structure from the start, and the going concern warning underscores the urgency. So, what is the bottom line? This filing offers a fascinating behind the scenes look at how SPACs operate, but for potential investors, it is a thicket of risks that needs careful navigation. Alright, that is our breakdown of XFLH Capital Corporation, SS-1 filing. What is your take on these numbers and what they signal for the company, S future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.